Hi, and welcome to a special edition of the Macro Show, where we're going to talk today about the differences between liquidity and insolvency events. I'm your host, Steven Van Metre, and thanks for joining me. Many of you have asked, Steve, what is the difference between a liquidity event and an insolvency event? Because many people believe that March was both wrapped in one. Well, really, March was a liquidity event. Now, it's helpful to understand what are they and how do they occur. Now, usually you see liquidity events occur first and then insolvency events. For example, in the Great Financial Crisis, the Lehman Brothers failure was a liquidity event, which was followed several months later by an insolvency event. Now, you might be asking, well, we had the liquidity event in March. Why haven't we seen this insolvency? Look at the stock market. Everything must be okay. Well, there's two reasons. One, the government transferred money to people, and two, we allowed people to not pay on their debts through forbearances. So let's take a look at the difference between the two. Now, a liquidity event, it begins when the plumbing in the market starts to bind up. Now, what did I mean by that? Well, in the market, there is a large number of overnight and short-term dollar loans that occur. Many of this goes on without you even knowing it. And there are providers who have dollars who are willing to make these short-term dollar loans because they are virtually risk-free. Many of them are overnight, and the interest isn't much, but since they have excess dollars, they're willing to make these loans. Now, liquidity events occur when these providers of short-term dollar loans suddenly feel that the risk in these overnight loans is too much, and so they start to back off on how much they're willing to lend. And we start to see these problems occur in the repo market. And I'm going to show you a chart here from the Federal Reserve database, and this is repurchase agreements. So what you're seeing here, even back in 2003, after the dot-com bubble burst, where the Fed was having to intervene in the overnight lending market and provide what's called liquidity or short-term loans, because the participants who normally do it were not interested in doing it as much as they needed to meet market demand. And it wasn't until the Great Financial Crisis occurred where you see a big increase in these overnight repo loans or short-term dollar loans from the Fed. So what happens in a liquidity event is the Fed needs to actually step in and provide the liquidity that the market isn't doing. Now, this is something the Fed is well equipped to do. They have the ability to offer short-term dollar loans, currency swaps. They've got the tools to solve that. And when they do that, the Fed will also lower the federal funds rate and increase or start quantitative easing. And the Fed does it maybe not because the market needs it, it's because the Fed doesn't know where the problem originated. So while we're here, we'll lower rates, we'll make financial conditions easier, and hopefully the problem will just go away. And sure enough, the problem usually will solve itself sometime later. Now we can see going into March of 2020, there is your liquidity event, and it began back in 2019. So anyone who was watching the repo market said, hey, this is a big warning sign, and boom, there was an explosion. Now you can currently see there is really almost no demand in the repo market, suggesting that the liquidity problems are gone. And that is a good sign that says that there is ample liquidity in the market. But it can't make an insolvency event go away. So what is an insolvency event? It's when a business or a consumer cannot pay on their loans or bills. So they choose to go into delinquency. See, they can't get money. There just isn't money for them, and they can't get a loan to make those bills. And those delinquencies then soon turn into defaults, and then the whole system falls apart. Now, the Fed, as I said, is well equipped to deal with liquidity events. They're not equipped to deal with insolvency events. And the simple reason is the Fed cannot give you money to make your mortgage payment or to pay on your bills. They do not have the tools or mechanisms to do that. Now, some people think, well, the Fed might own my mortgage. That's great. Whomever owns your mortgage is immaterial to the fact if you can't make the payment. So the Fed, again, is not equipped to deal with this and cannot stop insolvency events from happening. And in case you might be wondering why Fed Chair Powell continues to beat on the drum of more fiscal stimulus every time he is in front of a microphone or talking to Congress, is because he knows the pressures of an insolvency event are building and he cannot stop it from occurring. Now, the question then becomes well, why do they even happen in the first place? Well, it's simple. They all start with the same problem. The Fed sees inflation pressures building, and so it responds by raising the federal funds rate or doing quantitative tightening to constrict or slow the rate of credit growth. They do it every time. Now, see, in a debt-based economy, there is never enough dollars to pay on all the debt. So if we took all the money there was available and applied it to the debt, there would still be more debt than there is money. So when the Fed constricts credit over time, there are fewer and fewer dollars, but more and more debt that needs to be paid. And much like a game of musical chairs, it does reach a point where there isn't enough dollars for everyone to make their loan payments, and so the defaults begin. Now, this is normal. Even in a healthy economy, there are certainly people who file bankruptcy or default on loans and they can't make their bills. But in an insolvency event, it's when a larger percentage or a larger number of people cannot. And again, there isn't enough money for them to do that, and the Fed doesn't have the tools to meet those needs. Now, so this occurs, these insolvency events start due to a dollar shortage. And how do we know that? Because we can see in the weekly credit data. So here is the H.8 data. And if you look at this every week, you can see when credit is expanding or when it is slowing or contracting. And on the short-term scale, we're seeing credit contracting on a 3 and 6 month rate almost across the board. We can also see evidence of an insolvency event in the senior loan officer survey. And here what we can see is the banks are tightening lending standards. We can also see it in the futures market, where currently there is a 4 standard deviation net short by speculators. And on the opposite end of this trade are the commercial traders or large commercial banks. They're preparing for a major shock to come. So the challenge is investors never see either event coming. When the liquidity event happens and the markets go down, they quickly, eagerly jump in and buy because the Fed comes to the rescue. At that point, their perception is everything's back to normal. They cannot and do not ever see the insolvency event coming. If we look back, they didn't see the dot-com bubble bursting. They didn't see the great financial crisis, and they're not going to see the everything bubble. You always hear stocks are forward looking. Well, they somehow always overlook the insolvency event. So if we look back to the great financial crisis and we see in the housing market, there was a lot of insolvencies. So what happened? There were people who could no longer pay on their mortgages. Prices have gone up on homes so much that there weren't enough dollars to command more buyers. And those who had mortgages, some of them could no longer pay. And as housing prices came down, people who had multiple properties looked around and said, why should I keep making payments on something that I'm losing money on? And next thing you know, the dominoes started to roll and the great financial crisis bloomed into a major recession. Now, again, as I mentioned, the Fed doesn't have the tools or the ability to fix this. So many people ask us, how can you be so bullish on the bond market? Steve, can't you see the equity market? Can't you see what's going on? And here's my view. The insolvency event is yet to come. And certainly the pandemic is likely to make it even worse than it would have normally been in a normal recession. And in an insolvency event, there's some things I know are going to happen. Risk assets are going to crash, and treasury yields are going to crash, meaning treasury bond prices are going to go up significantly. This happens again every time. So from an investment perspective, I could make 2 choices. One, I could try to chase the equity market higher and hope to get out before things blow apart. Or I can take the more safer route and look down the duration curve to take risk on the long end of the curve, and then turn around and sell those bonds at the peak when risk assets are crashing and reinvest those gains back into the equity market. So my friends, now you know the difference between a liquidity event and an insolvency event and how you might be able to play that with your investments. So perhaps I could be wrong. And what if I am wrong? What if they both did occur in March and it's over and I'm wrong? Well, the economy is still really weak. There's still 20 million people unemployed. There still is a pandemic going on. So the chances of interest rates spiking and being wrong are pretty low. The odds are favorable that rates will still go down and bond prices will still go up, and there will be another market correction in the future where I can move from one asset class over to the other. That potential still exists. So now you know the difference between a liquidity event and an insolvency event, and why I can still be bond bullish and dollar bullish, because I believe the insolvency event is yet to happen. Thanks for watching, and I'll see you soon in a future video. The content of this video is provided as educational information only, is not intended to provide investment or other advice. It shows not to be construed as a recommendation or solicitation by or selling security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. The opinions expressed in this video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.